To continue with my lecture on taxes, I want us to assume that we bought 100 shares. Oh, that might be quite a few. Let's just do 10 shares of the Vanguard 500 ETF, Exchange Traded Fund. And the ticker for that is VOO, VOO. And let's say we bought those on January the 2nd because you actually buy those through your stockbroker or you can, and they are traded on the stock exchange, and the stock exchange is closed on the 1st. And so let's say we bought those on the first trading day of 2015. And I need to find out the price, so I'm going to pop over to Yahoo, and for some reason it usually displays a blue line in this graph to show me the price over time, and the line is not displaying. The data is there. I can see the prices change as I move my cursor, but it's just not displaying the blue line. And the price on a specific date is listed right here. So I'm just going to scroll until I find January the 2nd of 2015, and there I see the price is 188.40. And then let's say I sold it today. Today's price is 191.14. I'm just jotting that down. I see a few other things. I see that on March the 23rd, they paid a dividend of 90.984. And on June the 22nd, they paid another dividend of 0.902. And in September, they paid another dividend of 0.953. They'll also pay dividends presumably in December, but since I'm selling it today, I won't receive those dividends that they pay in December because you have to be an owner at the time that they paid the dividends to actually receive the dividends. And if they had paid any dividends, and they did pay dividends prior to January the 2nd, I wouldn't have received those because I didn't purchase it until the 2nd. It's not showing any dividends prior to the 2nd because I have a fairly short time period, but if I extended the time period on the graph, you'd see there were more dividends. So I'm just going to pop that into Word. And so I purchased it for 188.40 per share, and I sold them today for 191.14, and I received dividends totaling, oops, I didn't actually total them. I'll have to total them in a minute, of 0.984, 0.902, and 0.953 per share over the course of the time period that I held them. So what I want us to do is calculate the taxes that I would owe on this transaction or this investment. Before I actually work this, I want to talk a little about this ETF and just explain some things about it. I have it open in Morningstar. So I don't know if you can see the top of the screen. Oh, it didn't. Well, actually, now that I've got that, you can see that I've got the VOO fund open, and I'm on the portfolio tab, and then I'm on the holdings section of the portfolio tab. And I can see that this particular ETF owns 67,622,080 shares of Apple. And I just want to go look at Apple. I think I actually have it open here. Apple recently, just a couple of days ago, paid a dividend of 52 cents a share. So I'm keeping that in mind, and I'm going to pop over back to Morningstar to get the number of shares that they own. So VOO, the ETF VOO, owns 67,622,080 shares of Apple, and Apple just paid a dividend of 52 cents a share. So VU received a dividend inflow of what, $35,163,482 on November the 5th when Apple paid its dividend. That's quite a bit of money. However, the rule is unless VU distributes this to the shareholders who own shares of VU, they have to pay taxes on it. And I'll be a little more clear because I wasn't particularly clear. Um, if VU keeps this money, they have to pay taxes on it. Well, mutual funds don't like to pay taxes, so what they will do is distribute this money to the shareholders in VU, and then the shareholders have to pay taxes on it. Now, VU owns lots of other companies as well. It owns 500 stock in 504 companies altogether. Any of these companies might pay dividends in a specific month. So VU is receiving dividends basically every single month. Probably not every single day, but it doesn't have to distribute the dividends every single day. Instead, what they will do is just distribute them usually once a month. I'm sorry, once every 3 months, once a quarter to their stockholders. So they'll just hold the money that they collect in dividends in an account, and then finally, once a quarter, they'll tally up how much they owe every investor for each share, and they'll distribute the money to their stockholders. And I can see that information on Yahoo. Again, this is now the VU ETF, and I can see they paid a dividend per share of 95 cents to all their stockholders. And that was just them paying out all the dividends that they collected on all the companies that they owned for the third quarter of 2015. So that's kind of a side note. Now I want to actually work this problem. I need to know one thing though, and that is what tax bracket I'm in. So I'm going to assume that I am in the 25% ordinary income tax bracket. And I meant to get this open and I forgot to, so I need to find a table that shows me the tax brackets. And I know I had one before, but I forgot to open it and I forgot to link it and all those good things. So I'm just hoping that I can find fairly quickly a nice table. Oh, this actually summarizes it pretty good. It's not the same table that I'd used before. Oops, I'm looking for 2015. Here we go. And so let's say I'm single. I am in the 25% tax bracket. So if I am in and what they probably should have put here was ordinary income tax bracket. But if I'm in the 25% tax bracket, then I pay 15% tax rate on my capital gains and dividends. And technically, this is long term capital gains and dividends. So this isn't the best table, but this is the information I need to know based on that. Given that I'm in the 25% tax bracket, I pay a 15% long term capital gain and dividend tax rate. So all I have to do is provide you with your ordinary income tax bracket and a table like the one I showed you, and you should be able to figure out your long term capital gain rate. Your short term capital gain rate is the same as your ordinary income tax bracket. So, based on this, I need to make a determination. Did I hold the shares of VU long enough for them to be classified as long term? The answer to that is no. You have to hold them for more than a year for them to be classified as long term. Since I bought them on January the 2nd and I sold them today, which is 11/10/2015, that's not an entire year. So the capital gain portion will be short term, which means I'm going to have to pay a 25% tax rate on that. The dividend portion is going to be classified as long term, so long as they're qualified dividends. And I didn't actually mention that at all, but let's assume these are qualified dividends. Um, I seriously doubt that I'll give you a situation where you have unqualified dividends. But if you had unqualified dividends, they would be taxed as ordinary income, so you'd pay the 25% tax rate on them. But since I'm assuming these are qualified, we will pay the 15% tax rate on them. Now, it didn't used to be this way for decades. Ordinary or dividends were all dividends were taxed at the ordinary income tax bracket, and it was only maybe 10 years or so ago that they switched the tax that you pay on qualified dividends to the capital gains tax rate. And I think it was back maybe in 2012 or so, they were talking about ending that and retaxing or changing the tax rate on dividends to back to the ordinary income tax rate, but they didn't. That doesn't mean they won't eventually switch it back. From an investor's viewpoint, we actually prefer having dividends taxed at the capital gains rate because it's smaller, lower than the ordinary income tax rate. The government, on the other hand, would rather tax dividends at a higher rate because they get more tax revenue that way. So even though this was a capital gain, it is still being taxed at the 25% tax rate because it's a short-term capital gain. The dividends are taxed at the long-term capital gain rate of 15%. So, to do the math, I need to calculate my capital gain. So, I sold it for 191.14. I paid 188.4 for it. So, let me just pop my calculator up. So, I have a capital gain of $2.74 a share, not a whole lot. And I owned or purchased and sold 10 shares. So that's 27.40. That is my gain. It's not how much I received when I sold them. When I sold them, I sold 10 of these. So I actually sold them and got $1,911.14. But not all of that was gain. The gain, when I purchased them, I paid $1,884. So the difference between this number, or the 1,911.14 and the 1,884, would be my gain. Something seems wrong there. 1911.4 minus 1884. Nope, 2740. So there's the 2740. So I'm only taxed on that gain. To calculate my taxes, it would be the 2740 times the 25% tax rate. So I'll owe $6.85 in taxes on the gain that I have to report as a short-term gain when I file my 2015 taxes. That won't be till April, though, of 2016 probably, unless I file sooner. The and this is kind of interesting. Whenever you generate income through your job, your employer generally deducts taxes based on your withholding rate. And so you pay your taxes periodically through every paycheck deduction. With stocks, it doesn't work that way. you might not sell these shares this year, and the IRS doesn't know if you're going to sell them this year or next year or the year after that or whatever. So you don't even owe taxes on the the selling of your stock until you sell them. And then you owe the entire tax on the capital gain, and you'll just have to pay that whenever you file your taxes for that particular year. And the same with dividends. Here we don't owe a lot of shares. Sorry, we don't owe a huge amount. But what if I owned 1,000 shares of this company? Or what if my capital gain was much higher per share? I could end up owing quite a bit in taxes. Now, this is assuming also that the shares of VU were in a taxable account. If they were in a tax deferred account, I wouldn't have to pay taxes on them until I started withdrawing money. But now let's calculate our dividend portion. I need to do one thing though to make that process easier. I'm going to sum these dividends. So I received 0.984 per share one day, and then when they paid dividends, I got 0.902 on those, and then 0.953 when they paid dividends for the third time that year. So I got a total of $2.84 about in dividends. So my total dividends, 2.839, I think it was. I can't remember exactly what it was. And that was per share. So now I multiply by the 10 shares that I owned, and I'll receive $28.39. I didn't get it in a lump sum. Basically, they paid it to me in small increments. Since I owned 10 shares at on one day when they paid this dividend, I received money in my account in totaling $9.84. The 98 cents per share times the 10 shares that I owned. The next time they paid dividends and it was 90.2 cents per share and I owned 10 shares, I got $9.02 credited in my account. And the next time they paid dividends, I got $9.53. So I got it in three separate payments, but all three of these payments occurred during 2015, which is the only time that I owned the shares of VU. I didn't own these shares back in 2014. So the IRS doesn't care exactly when in 2015 that I received these dividends, just that the dividends for 2015 totaled $2.84 per share, and that I own 10 shares of them. So I owe taxes on this entire amount now, and the tax rate that I owe is 15% because they're qualified dividends, they're classified as long-term capital gains, and that rate for me is 15%. So for my taxes on the dividends, I'm going to owe the 28.39 times 0.15. So I'll owe $4.26 in taxes on my dividends. So altogether on this transaction, I'm going to owe the 426 and the 685. Now, let's say that I had purchased shares of VU back in 2014, maybe January the 2nd of 2014. And they paid dividends. And actually, let's just pop over to Yahoo and let's pretend I bought them on January the 2nd of 2014. I'm just trying to get to that date. That's right here. You can see that they paid some dividends in 2014 and then they paid some dividends in 2015. Um, and let's say I bought it January the 2nd of 2014 and sold it today, November the 10th, 2015. I would pay the taxes on the dividends that were paid in 2014. I would actually pay those when I filed my 2014 income tax form. I would pay the taxes on the dividends that I received in 2015 2015 when I file my 2015 income tax form, which probably won't be until 2016. Not probably, will be in 2016. So you pay dividends on the you pay taxes on the dividends in the year you receive those dividends, but you don't pay your capital gains tax on selling your shares of the fund until you actually sell them, the year you actually sell them. So, like, I've got shares of funds that I purchased 25 years ago, and I've never paid taxes on them because I haven't sold them. All right, I want to do another example that's a little more complicated. This time, I'm actually assuming I'm buying shares of stock, but these could easily be exchange traded funds or even mutual funds. So these are real companies. This is Microsoft, IBM, Ford, and Krispy Kreme Donuts. And I'm just pretending I bought a certain number of shares of them at different points in time. And I made up these purchase prices and I made up these selling prices. So don't go look up Ford and say, oh, it's really not trading for $22.19 because I just made that, excuse me, I just made that number up. And I also just made up these dividends. Um, Now, I bought my shares of Ford, I'm pretending, back in August of 2012, and I'm saying that Ford paid dividends totaling 19 cents a share at, at points from the timeline of August 9th, 2012 through today, which is November 10th of 2015. So these taxes that I'm going to owe on the dividends, I'll have to pay them at different points in time. Some I'll owe probably in 2012, some in 2013, some in 2014, and 2015. Because again, you pay taxes on the dividends in the year that you received them. So, my question in this example is how much will I owe in taxes if I sell all my shares today? Now, I'm going to again assume I'm in the 25% ordinary income tax bracket. That will put me in the 15% capital gains tax bracket. I usually just write capital gains as CG. But again, I will pay this 15% capital gains tax rate on my qualified dividends, and I'm assuming all my dividends are qualified, and on my long-term capital gains. On short-term capital gains, I have to pay the 25% ordinary income tax bracket. And if I had any unqualified dividends, I would also pay 25% on those, but I'm not assuming we have any unqualified dividends. So I need to first figure out whether I've got a gain or a loss. And that gain or loss is determined by whether I sold the stock for more than I paid for it. So I sold Microsoft shares today for 33.14 and I bought them back in March of 2014 for 23.89. So I have a gain. My shares of IBM, I sold them today for 11.18, but I paid 14.29 for them back in February of 2013, so I have a loss on those. I have a gain on my shares of Ford, and I have a gain on my shares of Krispy Kreme. And then I also need to classify this gain or loss as a short term or a long term. So short term slash long term. And what determines whether it's short term or long term is whether I held the shares for at least a year. So my shares of Microsoft, I bought them in March of 14, sold them in November of 15, so that's more than a year long term. Microsoft bought way back in 2013, sold them in November of 2015 long term. Ford long term. And Krispy Kreme, I'm pretending I bought them yesterday and I sold them today, which would be a really quick turnover, but that would classify them as short term. All right. Um, so now what I'm gonna do is just tally all my dividends. So my total divs. This is my per share dividend in column F. I want to calculate my total dollar dividend. To do that, I just take my per share times the number of shares that I bought. And I'm just going to link my cells, but you can easily just type this in into a calculator. So I'm going to take my 32 cents per share total that I received from investing in Microsoft times the 100 shares of Microsoft that I own. So from March of 2014 through today, I received dividends from Microsoft totaling $32. For Ford, I'm sorry, IBM, um, it didn't pay any dividends, but I owned 200 shares and got no dividends, so my dividends totaled zero. For Ford, I got 19 cents per share in dividends and I owned 150 shares, so $28.50. And I know I can just copy these formulas down, but I'm typing them out so y'all can see. Um, and then for Krispy Kreme, I got dividends totaling 4 cents, and then I owned 100 shares, so I got $4 in dividends total. And then I just want to sum all these total dividends. So altogether, over the entire course of time that I held these stocks, I received $64.50 in dividends. So my taxes on the dividends will be equal to the 64.50 in the dividends that I received. Oh, I'm gonna, I'm gonna do this. It's gonna be the 64.50 total dividends that I received times the tax rate that I pay on dividends. And since dividends are taxed as long-term capital gains, I owe a 15% rate on that. And that's going to be equal to 0.15 times 64.50. So I'll owe $9.68 in taxes on my dividends. Now I need to figure out my capital gains taxes and deal with that capital loss and deal with the fact that some are short term and some are long term. All right, I am going to freeze these panes so I can scroll and y'all can still see that data. So capital gains and losses, and it's technically the taxes on them. First, I'm going to do the long-term ones. And my long terms, I've got some gains and I've got a loss. For the long term, I have a gain here. I'm just going to highlight it. And I have a long-term gain here. So I just want to tally those. So I have a gain on Microsoft, and I owned 100 shares times the gain, and I need to calculate the gain. The gain is calculated by just taking the selling price minus the purchase price. So I sold it for $33.14. I paid $23.89 for it. That's the gain per share, and then I multiply by the 100 shares that I own. I'm just typing in a label right there. I'll actually do the math right here. So it's going to be 33.14 minus 23.89 times 100. There's my gain on my shares of Microsoft. Then I also had a gain, long-term gain, from my ownership in Ford. So for Ford, I owned 150 shares and I need to calculate the gain. It's going to be the 22.19 minus the 18.19. And again, I'll just do the math here. So 150 times 22.19 minus 18.19. So $600 is my long-term gain on my ownership in Ford. I'm going to come down here and calculate my total long-term gain. And it's just going to be the 925 plus the 600. Now, I could just calculate taxes on that number, but when you have losses from your ownership in stocks or funds or what have you, you can deduct the losses. You can use your losses to offset some, if not all, of your gains. So I have a loss here. I want to calculate it, and it's a long-term loss, so I need to group my long-term losses with my short-term, or sorry, my long-term losses with my long-term gains. That's what I'm talking about it right now. So I can write off this loss that I had on IBM against gains from my positions in Microsoft and Ford. So I'm going to come down here and do losses. Only had one of those, and again, it's long term, that's why I'm doing it here, and that was from my ownership in IBM. And I own 200 shares times, now I need to calculate my loss. My loss is the 1118 minus the 1429. And again, I'll come down here and actually do the math. So the 1118 minus 1429 times the 200 shares that I owned. So that generated a loss of $622. I am allowed to offset this loss against these gains. So they call that your net. It would be a net gain or a loss, depending. My gain outweighs my loss, so my net is a gain. And to calculate, I just take the 1525 minus, actually, because I have my loss reflected as a negative, if I did 1525 minus a negative 622, it would actually add the 622, and I don't want it to. I want it to subtract it. So since I have my 622 as a negative number, I'm actually going to add it, and that way it'll really subtract it. So my net loss is $903. Sorry, net gain, 903. I'm going to owe the 15% tax rate on that because it is a long-term capital gain. So to figure out the taxes that I owe on it, I'll take the 903 times the 15%. Here's what I owe in taxes on my long-term net capital gain. I'm actually just going to highlight that in orange. So that's the taxes I owe on my long-term net capital gain, which means I've also then dealt with this loss. I'm just going to code them all yellow because I've dealt with all of those. And I've also dealt with all my dividends, so I'm going to code those yellow as well. I still haven't dealt with the short-term capital gain, which I will in a bit. And then the taxes on my dividends, we calculated those earlier, $9.68. Now it is time to deal with my short-term capital gain or loss. But in this case, it's a gain, and it resulted from buying Krispy Kreme on the 9th of November of this year and selling it a day later for more than I paid. And so, Krispy Kreme, I owned 100 shares, and I need to calculate the gain. It would be the 845 minus the 718. And I'm just trying to line things up good. So here is where I'll actually do the math. 100 times the 845 minus the 718. So I had a short-term capital gain of $127, and that's the only short-term gain or loss that I had, so I don't do any more. I pay the ordinary tax rate on the short-term capital gains, and that was 25%. So to find out my taxes, I take the 127, which is the short-term capital gain, multiply it by the 25% tax bracket. So here's the taxes that I owe on that short-term capital gain. So all the taxes that I pay in orange, I'm going to just total them. So my total taxes will be this 3175 plus this 135.45 plus this 968. The deal is though, these taxes right here in orange will be paid when I file my taxes for 2015 because they relate to capital gains and losses. And I only pay those taxes the year I sell the securities and generate the gain or loss. Actually, technically, I only pay it when I file my taxes for that specific year. The, this tax amount is paid in various years. Some of it's paid in 2012 because and some of it's, well, because I owned Ford back in 2012, assuming part of Ford's 19 cents that they paid in dividends total occurred in 2012, I'll owe the taxes on those dividends in 2012. And I still held it in 2013. And I also had some shares of IBM, but IBM didn't pay any dividends, so I'll ignore it because these are only dividend taxes. So basically, these taxes are spread out over 2012, 13, 14, and 15. Whereas these taxes are all due when I file my 2015 tax return. All right, I only have a little bit left. Hopefully, it won't take too long. Oops. All right. The book talks about different types of mutual funds. They classify some as tax managed mutual funds. And I just want to list what makes something tax managed versus just tax efficient, which is the other kind. But before I do that, let me explain one thing. I've already talked about it, but I want to just emphasize it. To generate a capital gain, which means you owe taxes on that capital gain, you must sell a security for more than you paid. If you bought shares of IBM and the shares have risen in value, but you don't sell them, you might have, well, not you might, you will have what they call an unrealized capital gain, meaning because you've not yet sold the shares, you've not realized that gain. Until you have a realized capital gain, you don't owe taxes on that unrealized capital gain. You only owe taxes on the realized capital gain, which means you must actually sell your shares to generate the capital gain before you owe taxes on it. So, this gets at the idea of turnover ratios. Turnover ratios, remember, represent the average length of time a fund holds a security before it sells it. So if a fund has a low turnover ratio, that means they don't actually sell securities that often and they don't generate realized capital gains, which means they don't generate capital gains that they must pass along to you, which will be taxed. So funds with low turnover ratios will have typically I'm not quite sure how to describe that. They'll be more advantageous for us tax-wise. And tax managed funds typically have low turnover ratios. They also purposely tend to, I'll phrase it this way, they'll purposefully avoid securities that pay dividends. Because if they buy stocks that pay dividends, They have to pass those dividends along to you, and you're going to have to pay taxes on them, assuming they're not in a your fund isn't in a tax deferred account. Or if they do buy securities that pay dividends, they'll pay low dividends. They also engage in tax loss harvesting, which is essentially selling securities that have generated a loss so they can use that loss to offset gains. So I own some shares of Apple and I've earned about a 50% rate of return. Actually, I haven't earned it, it's an unrealized capital gain. But let's say for whatever reason I decide to sell those shares of Apple. This, like before the year ends. That means I'm going to have to pay taxes on that capital gain because it'll turn from an unrealized capital gain into a realized capital gain. Well, I don't like paying taxes. So I also own some shares in another company that hasn't done particularly well. And I could hold on to those shares and hope that the company recovers. And I mean, right now I've got a loss in that investment. I can't think of the name of the company or I would tell you. Um, let's say it's shares of Ford. It's not, but I just can't remember what company it is. So let's say I bought shares of Ford and right at the moment they've generated a loss. So I could hold on to my shares of Ford, hope it recovers, and then sell them for a profit. But that could take 3 years, 4 years. I don't know how long it's going to take. Or I could sell my shares of Ford that would generate a realized loss, and I can use that loss to offset some or all of the gain that I have on Apple. And if I do that, it will reduce my taxes. That's the idea behind tax loss harvesting. Now, for personal income taxes, we are limited to how much we can write off in terms of losses. Let's say I have a capital gain of $10,000, all associated with 2015 from trading securities. And I do also have some capital losses of, let's say, $15,000. And let's say these are all long term. I can use 10,000 of this 15,000 to offset all of my capital gain, but that still leaves me with, here, let me just type that in. Use 10,000 of the $15,000 long-term capital loss to offset the $10,000 capital gain. And this leaves me with $5,000 of what I'll call leftover long-term capital losses. Well, I'd like to use those capital losses to offset some more taxable income, and the IRS currently the rules allow me to do that. I can use $3,000 of the 5,000 to offset my ordinary income, which is cool. So basically 3,000 of this 5,000 can be used to reduce my taxes on my ordinary income, but that still leaves me with $2,000 that I haven't been able to use to offset anything yet. So long-term capital losses. What I'm allowed to do with this money is carry it over to the next tax year. I think they call it a carry forward. I can carry it forward to the next year and use it. And let's say I don't have any capital gains or losses next year. I can then use this 2000 to offset my ordinary income tax, or ordinary reduce my ordinary income. So it'll reduce the taxes that I owe on my ordinary income, only because it's less than $3,000, because the rule is I can only use up to $3,000 to reduce my ordinary income. If if this had been, I don't know, $25,000, this would leave me with 15,000 here. I could still just use 3,000, but that would leave me with 12,000 in short-term capital losses. I would carry the 12,000 forward to the next year where I could only use 3,000 of it, assuming I didn't have any other short-term, or sorry, long-term capital gains to offset the 12,000 with. So when you carry it forward, you can only carry forward 3,000 a year in essence. All right, anyway, that was sort of a side note. So I was talking about tax loss harvesting. Now I'm on to HIFO accounting. HIFO accounting stands for highest in, first out. And it's a rule that mutual funds follow whenever they sell shares of stock. So, as an example of HIFO accounting, let's say a fund owns shares of Microsoft, and they bought 60 days ago 20,000 shares at $29.60 each. Just making these numbers up. I've lost my mouse. There it is. And then 45 days ago, they bought 18,000 shares. Not That's not dollars. At 32.49 each. And 30 days ago, bought 17,000 shares at 36.18 each. And finally, 15 days ago, bought 16,000 shares at 35.49 each. And today, they need $1 million in cash. Maybe that's because a big client that they, or shareholder that they had, decided to cash out a lot of stocks, or shares of, not stocks, shares of the mutual fund. They decided to redeem a lot of shares, and so the fund needs $1 million in cash to pay for that shareholder's redemption. And they decide to sell shares of Microsoft to raise that $1 million in cash. And Microsoft is currently trading at $37.46. So, how many shares are they going to have to sell? They need to raise $1 million in cash. Each share that they sell of Microsoft will bring in $37.46 in cash, so they need to sell 26,695 shares. Now it's a question of which shares do they sell? Do they sell these shares? Do they sell these shares, or these shares, or these shares? Well, they want to do it in the order that's going to result in the lowest capital gain. Regardless of which shares they sell, they'll still get 37.46 per share. They have gains on all these shares because the prices for right now, 37.46, are higher than the prices that they paid for these shares. But if I sell these first, that's going to generate a smaller capital gain because this was the highest price that I paid. So I take the highest in and I sell those first. They become the first out when I sell. So what I'm going to do is sell, I'll highlight those. I'm going to sell these first. So since I own 17,000 of them and I need to sell about 27,000 of them, I'm going to sell all 17,000 shares at a cost of 36.18. And that's going to mean that I need to sell some more. 26,695 is how much I need to sell altogether, and I just sold 17,000 of them. So I still need to sell 9,695 shares. So I go to the next most expensive, which were the ones that I bought 15 days ago for 35.49. So I will sell 9,695 of the 16,000 that I own. So I will sell 6,000 or 9,695 shares at a cost of 35.49. So I would take the 17,000 times the 36.18, the 96.95 times the 35.49. That would give me my total cost. And I would subtract that from $1,000,000 to figure out my total capital gain. And this process will result in the smallest total capital gain for this fund, because we have sold the most expensive shares that we purchased first, because the more you pay, the smaller your capital gain is.